Rohr here with an early global view on Tuesday, August 25th, 2015. It is currently 7 a.m. U.S. Central Time. And of course, we wanted to wait until today to do the first video analysis of the week so we'd have the actual displays from yesterday's very wild and woolly session. Not a huge surprise the market was off, but it did look like a bit of a climactic move, and that's being backed up by the improvement in U.S. and European stocks today. We'll get to that momentarily. And we need to ask what that means to the markets. Well, first of all, if you get the U.S. markets not acting quite as badly as Asia, as China specifically yesterday to begin with, even though we had this crazy 1,000 points lower on the Dow and 100 points and change lower in the S&P, we now have those markets having held up a bit better, even though they came under pressure later on in the day anyway, are up now today. Okay, are you ready? Up 73 at 1945. So right back up toward yesterday's high. Now that's kind of important, but you'll note also right in that area is the Fibonacci third retracement of the whole swing down, and that's from the actual trading high here, although it was 2132 on the lead contract going back into May. The SEP contract was trading at a discount, so it's 2125 down to yesterday's low. That is the one-third retracement area, and the halfway retracement's up at about 1978. Which of course fits right in with whether the market can significantly overrun last week's close it gapped down from at 1971.40. What we do know is the market's going to be on an up break this morning from 1906, and that's important because in addition to getting back out above this low 1900 25% retracement on the Fibonacci's, the low 1900 area starting at 1919, which was the downside objective of the 10% correction from the lead contract trading high. 10% less than 2132 is 1919. So it's going to be very important to see not just how it does on this gap higher, but whether overall it holds back around that level or modest washouts back in the no worse than the low 1900 area, above which it actually stabilized temporarily after the wild exhaustion capitulation in the first hour. And if it should get back above 1971 to 78, of course you do have further significant resistance up into 2015 area. Now it's interesting, that's the two-thirds retracement more or less of the entire swing down, because it's also, as you will see, the important weekly channel down break. The same channel it held last October down the low 1800s on the Ebola scare was broken last Friday when the market remained under pressure. And that pretty much does it for the short-term view of the S&P 500.